We're turning now to our fourth panel on reform of the global financial architecture. As I said at the outset this morning, that's another issue of some dispute between the United States and at least some in Europe, and we thought it would be essential to include that topic on today's agenda. Our lead-off paper will be by Ted Truman here at the Institute and Gary Shanassi. Most of you know Ted, who for many years, of course, headed the International Division at the Fed, spent 2 years as Assistant Secretary of the Treasury for International Affairs, and has been here at the Institute for almost a decade since that time. He's been widely quoted of late on these issues, on some of the other current issues on international finance, and has written very widely. And in fact, we're about to publish a new book by him. We'll be releasing it on Tuesday on sovereign wealth funds. But today he returns to, I don't know if it's first love or last love or some love, but IMF reform. Gary spent many years at the IMF and is on sabbatical from the fund now. He for many years co-managed the flagship publication there, now called the Global Financial Stability Report. He's been with our partner institute for today, Bruegel, for about a year as a visiting fellow while on sabbatical from the IMF. He had spent a number of years at the Fed before joining the IMF, which has been his basic professional home. We then have four discussants, three discussants actually. The first, and I want to particularly thank him for joining us, is Jörg Asmussen, who is the State Secretary in the German Ministry of Finance, but as most of you probably know from reading the papers, Minister Schäuble has been hospitalized for a period, not serious, Jörg assures me, but simply a problem emerging from an operation he had a year ago and has to get some maintenance work, so to speak, so he couldn't come. So Jörg Asmussen is chairing the German delegation here at the fund bank meetings, and we're particularly therefore pleased that he could fulfill his commitment to the conference and come and join us for this event today. He's been State Secretary for about a year. He's in charge of financial market policy, European policy, German federal holdings, has had a distinguished career in the ministry, and as I say, now takes over as essentially acting minister during this period. Our U.S. discussant is Ken Rogoff, who of course teaches at Harvard. Ken spent an extensive period as chief economist at the IMF. He had previously taught at Princeton, at Berkeley, spent some time at the Fed, an earlier stint at the IMF. He, of course, is now ultra famous for co-authoring the famous book, This Time It's Different, 8 Centuries of Financial Folly. I use that as a point of departure to call your attention to a press release in your material where we have been exceedingly pleased that his co-author, Carmen Reinhart, will be joining the Institute as our Dennis Weatherstone Senior Fellow as of November 1. So we will at least have half the Reinhart-Rogoff team here. You note that I at least will now say Reinhart-Rogoff rather than the reverse as it has traditionally been, but that's just my vested interest, and Ken will understand that because he knows me pretty well. Our other discussant, and that's from the non-transatlantic perspective, is Guillermo Ortiz. Guillermo was, of course, governor of the Bank of Mexico, the Banco de Mexico, for 12 years until early this year. Really, I think, presided over the ascent of Mexico to be, if not a fully industrial high-income country, at least moving very rapidly, very decisively in that direction, and with a quantum maturation of its financial system under his leadership over that period. He had been Secretary of Finance and Public Credit prior to becoming governor of Central Bank. He'd been essentially finance minister for 5 years. So he has really been the person who has led and steered Mexico's evolution as a major, mature, advanced financial country, as well as a mature economy as it has become. So we're delighted with the group. I'll ask Ted and Gary to start off. Each speaker will address from here, then the panel will take the podium up in front for discussion with the audience. Ted. Gary.
Thank you, Fred, for that nice introduction. While I'm making some preliminary remarks, I'll let you look at the roadmap of the presentation. I'm really Ted's setup man because Ted is going to address the reforms and the reform challenges and the many recommendations that we make in the paper. I'd like to thank the conference organizers. I'd like to thank Bruegel for inviting me to write this paper with Ted, and I'd like to thank the European Commission for supporting this effort. In the paper, Ted and I distinguish between the international or global monetary system and the global financial system. And this paper focuses on the financial, not the monetary arrangements. And we ultimately narrow the focus even more to discuss the IMF's and the FSB's role in safeguarding financial stability. So it's really the financial stability architecture that's the focus of the paper. As the roadmap shows, I'll start off by reviewing the pre-crisis framework, and then we'll go on from there. I may have to skip a slide or two because we have only 15 minutes, somewhere between 15 and 20. Okay, so the pre-crisis financial stability policy framework can be summarized in this chart in simplified form. The columns more or less define the sources of systemic risk to global financial stability. The rows define the lines of defense that policymakers, primarily in the U.S., well, it's the transatlantic policy framework, more or less. There are exceptions to that. These define the lines of defense against these sources of systemic risk. This wasn't ordained by some genetic code. It developed over time. It's kind of organic. It changes over time. Just to give you a feeling for what each cell means, if you look at the first column, global financial institutions, they are subject to policies in each line of defense, all five. If you go to the unregulated financial activities, you'll see that there is no regulation, there is no supervision, there's some surveillance, but there is no framework for crisis management and resolution. They're basically ruled from a stability perspective through market discipline and transparency. The upshot of presenting this simplified framework is to point out that a lesson of the crisis is that all of these lines of defense did not perform as intended. They in effect failed to prevent systemic risk in each of these dimensions. Now, part of that architecture that we'll focus on is the IMF and the Financial Stability Board. This slide lays out their policy-focused tools of governance and accountability. I think you all pretty much know what these institutions do, so I don't want to dwell on it too much. I guess the main observation we make in the paper is that these are two very different institutions. The G20 has mandated that they work together more closely than the IMF and the FSF did in the FSB's previous life to help safeguard financial stability. So two very different institutions. One of them has a balance sheet, policy tools, a very different governance structure than the FSB, which doesn't have a balance sheet. It doesn't really have policy tools, but it has the mandate to coordinate the G20 governments in establishing standards, in implementing themselves, and in trying to get the broader community to also buy into those standards. Nevertheless, they have to cooperate in safeguarding financial stability. Ted will talk extensively about how the weaknesses revealed by the crisis will have to be worked out by the IMF and the FSB in establishing guidelines, principles, standards, and codes for safeguarding financial stability. What do we know from the crisis? Well, as I said earlier, in all of the dimensions of the framework, there were weaknesses and failures. First and foremost, private risk management and market discipline did not work as intended. We observe in the paper that there was an imbalance between reliance on market discipline and reliance on official intervention. Prior to the crisis, there was probably too much reliance on market discipline, which worked after the fact rather than before the fact. And as we all know, after the fact, market discipline worked too well. Markets, in effect, dysfunctioned. As I implied, official supervision, particularly of the systemically important financial institutions, did not perform as intended. In fact, it failed. Macroeconomic policies contribute to the environment that made the global financial system conducive to the weaknesses. National and global market surveillance was unable to identify the buildup of financial imbalances and risks until it was too late. And the pre-crisis central bank and finance ministry tools proved to be insufficient for resolving all of the liquidity and solvency issues before a systemic event arose, and also later for restoring market trust and confidence. So Ted and I identify 6 principal areas where reforms are necessary. I think Mario Draghi and others in earlier discussions identified many of these. The transatlantic debate has formulated ways of re-regulating at the microprudential level, and it's manifest in new capital, liquidity, leverage, and systemic risk taxes. Well, capital, liquidity, leverage requirements, and systemic risk taxes or levies. These are still being discussed. Second, a challenge is that the perimeters of financial regulation and supervision and the infrastructures need to be rethought. And in fact, as Mario pointed out, they are being rethought. Moving into the shadow financial system is a key area. It's a major challenge. Global money and financial markets are now being thought of as needing regulation. I don't think anything tangible has yet been done. We're talking primarily about the over-the-counter derivatives market. It's in essence the modern interbank market. It's where global banks manage their liquidity needs and their clients' needs. It's at the core of the international financial system, and it's a key challenge to regulate them, and it needs to be done in a coordinated way. Otherwise, money will tend to flow to the least regulated jurisdiction, and then we're just back to square one again. As Morris and Nicolas wrote about, the SIFIs and the too big to fail problem is a major problem. Crisis management, rescue and resolution, and the effective management of volatile capital flows. There hasn't been much discussion about that except within the context, I guess, of exchange rate dynamics earlier today. Ted will touch on that a little bit more. And in fact, I think he's one of the leading experts in that area, in particular with the IMF reform. What is our sense of the report card so far in reform efforts? Well, we think it's a weak to mixed picture overall. National efforts have not yet really been fully agreed. Implementation in both the EU and the US has been slow. That is not to say that there haven't been major progress made in thinking about the new framework through the Dodd-Frank bill, through the implementation in Commission legislation of the Larosière Group's recommendations. The recent Basel III agreement is progress, but Ted and I are disappointed about it, in part because of the slow implementation of capital standards. There was a weakening of the definition of core capital, and in our view, two of the most important components, liquidity and leverage, which after all were the major causes of the crisis, are put off until, I think, the year 2019 or 2018. That's a long way to wait to reform bank management of liquidity and leverage. IMF resources and facilities reform, we say okay because its resources have been bolstered and the reform is underway. More is needed on governance and surveillance of the global financial system. We see the FSB as a step forward, but we also see financial stability forum legacy problems in the FSB, which we think need to be worked out. I'll now turn it over to Ted.
Well, thank you. Whoops. Oh, here it is. It's on this one. Why isn't it on that one? There you go. Well, proving when I worked at the Treasury Department in 1998, my senior advisor declared me as technologically challenged, with good reason. Thank you. It's been a pleasure to participate in this project and to work once again with Gary on thinking about some of these issues. And basically, what I'm going to do is talk a bit about the principal international institutions, the fund and the FSB in this area, and the capacity of those institutions individually and collectively to address the key global financial issues that Gary has outlined. We spent quite a lot of time in the paper talking about the institutions and where they come from and where they're going, and they are, as Gary said, they are overlapping. They're different institutions with separate but overlapping mandates, and that leads to some degree of perhaps of, and certainly historically, of competition and tension. But they are in this together. We have a section that talks about the paper, about how they compare with respect to various dimensions listed here in terms of their membership and representation and therefore their legitimacy. In this case, under this category, the fund, being a universal organization, has a lot more, has a more legitimacy deriving from that fact. On the other hand, the FSB has an advantage in that it very much more involves central bankers as well as regulators in its operation. Central bankers and regulators are somewhat traditionally been somewhat at arm's length from the fund itself. Tools and instruments. As Gary outlined, the fund has a number of tools, not very powerful ones, not nearly as powerful ones as Fred would like them to have, but the FSB's role is one primarily of coordination with a bit of a peer review process. It therefore follows that when it comes to compliance and leverage, that the fund has considerably more, or some more leverage in terms of compliance, and plays that role more so than the FSB. In terms of macroprudential issues, there the fund is very much more active. But as I said, one issue is that the FSB has involved more of the central banks in its processes. And as far as accountability and transparency, an issue which I guess we haven't mentioned too much come up in some context in today's discussion. Both the institutions have their challenges in this area, even though in the case of the fund and the FSB itself, there has been some progress in recent years. So we then, just to remind you of sort of the context in which these two institutions operate, is essentially the Mario Draghi Strauss-Kahn letter of November of 2009, which actually went out before the first summit. So in some sense, it predates the elevation of the FSB and its expansion, and changed in some, and its expansion also changed to some extent its relationship to the broader architecture of international finance. But the letter outlines basically that the surveillance role would be largely one of the conducted by the IMF, but as we've heard and talked about earlier today, and Mario did, that was somewhat qualified because the FSB itself has been assigned, I should say, by the G20 also to do some surveillance activities. Standards are largely set by the FSB and the related standard-setting bodies, though some of the standards around the world come from other sources, such as the money laundering standards and so forth and so on. But the implementation of all this is at the national level, subject to IMF assessment. I think this is a key point. We don't talk about what the countries have to do, the United States and Europe and the EU in this area, but obviously you can have a nice structure either on paper, but the real question is whether it is implemented by the national authorities. And lastly, there's this early warning exercise which is joint between the two institutions. There is a certain, I was interested in the discussion in the previous panel about peer review, which comes up under this category, and I put myself down as a skeptic in this area, maybe because I went through the process of peer review that was involved in cooperation that was involved in the failure of a major international financial institution in 1991. These are the 6 issues that Gary laid out, just to remind you about them. And if you think about sort of how they might get assigned in terms of the fund and the FSB, the first one, certainly the fund in terms of capital, the FSB takes the lead, but the IMF has been involved and certainly has been involved and contributed, as particular in the area of the tax debate. Under the perimeter, as we heard from Mario, in some sense that's the natural assignment for the FSB, though they haven't gotten too far. And it's a more complicated issue because in some areas it is probably smaller than the FSB countries involved, but especially when you get to the question of infrastructure, it actually involves a much larger set of countries. Similar points could be made about the global money and financial markets, and we've talked about the too big to fail problem and the systemically important financial institutions. Obviously, the fund is the lead institution as far as management of financial crisis, but there is a common sense management is preceded by crisis prevention. The crisis prevention area is shared. And lastly, the fund, as far as management of global capital flows, is the lead. The bottom line is that none of these issues really falls neatly into one organization or the other. I think that's, and therefore there has to be cooperation. Our broad conclusions are that the global financial architecture needs more reform. And actually, I'm not sure anybody would disagree with that at one level, since we're only partway through this process, even though we made a lot of progress. We also conclude that the world is not ready for a global regulator, not surprisingly. And the FSB is not, although some people like the Secretary of the Treasury and the Governor of the Bank of Canada like to think about the FSB as being a fourth pillar of the Bretton Woods system or the post-war system. We think that that's certainly not true now and is not probably likely. The fund and the FSB are different, but they should be aligned in their financial sector stability operations. We outlined there with the fund's roles and the FSB's roles. But for both, as I said just a minute ago, the key is to affect national policies and priorities rather than just paper shuffle. Our recommendations, one, just to start with the controversial, is that we think there should be a foundation of European representation on both institutions as much as possible. Sooner the better, in the interest of Europe and the institutions themselves. If there is we don't favor particularly a move to a constituency system in the FSB unless that's done at the level of the G20, but that's above our pay grade to talk about largely. We do think that the FSB should engage with non-members through regional meetings and so forth. And I was pleased or interested to hear that Mario Draghi emphasized that point, that is their intention going forward. So one of our recommendations, Fred, has already been taken, so we can take credit for that one. And John, Mike, you take credit for everything good that happens in the world, right? We think the fund should leverage the presence of central bankers in the FSB context to have more discussion of the macro potential issues. Macro meaning, and I like to draw the distinction between, there's the macro meaning aggregation of risks, which is often called macro financial, and there's the macro that's in the sense of how macro policies impact the financial system. There's been a tendency, I think, erroneously, in the post-crisis period to emphasize the former rather than the latter. And the management of capital flows, volatile capital flows, should be on the agenda of both institutions. We heard a bit about this from Stan Fisher at the start of the conference. I've been pushing this. And one might say, well, why is this really the FSB's time? One more minute, and if you will. And I can stop, but we want to formalize the reporting of FSB, the IMFC, which actually is already going on de facto. We would like to consciously enable the IMF to task the FSB rather than just the other way around. We think both institutions need more resources of financial expertise, in particular to fortify the FSB Secretariat. And we recommend dual chairs. I was interested that Mario said that in this regional outreach they're going to have dual chairs for that process, which sounds very, very interesting, and they should do it along the board. And we think that they're partly to deal with some of the capture issues that have been discussed, that using more outside experts in independent panels. I have changed my view on this matter since I've become an outside expert. I have a bit stronger view and Barry and I have a stronger view about outside experts. And last, we have in brackets, because this is where we're not completely agreed, this idea that maybe in the future one could see an evolution in which the FSB Secretariat at least became merged into the IMF, but that clearly is well down the road. But basically, in terms of the transatlantic dimension here, the bottom line is that Europe and the United States have a joint interest in making this process work. Thank you very much.
Okay, thanks to Gary and Ted for the paper, and we'll lead with our European discussant, Mr. Minister, Jorg Asmussen.
Yes, Fred and ladies and gentlemen, yes, thank you very much for inviting me at the Peterson Institute to discuss the paper that Ted and Gary have presented. I'm pleased to comment on this, even if I may say that I would not subscribe to to anything that is written there, let's say not on all aspects on the FSB work and not especially what is written there on Basel 3. But first, Fred, I have to correct you, never call a civil servant a minister. You will cause him deep troubles. So.
Mr. Acting Minister or something.
Oh, no. I think the paper has two relatively distinct parts, which were then put together at the conclusions. You have first the pillar of strengthening financial market regulation, and second, you have the question how you boost the effectiveness and the efficiency of the international financial institutions. And yes, I think it's clear that these two elements will at the end reinforce each other. And we are on a way to do this, since I think it's clear, and here the paper is pretty outspoken, that no doubt the recent financial crisis has revealed major deficiencies in the global financial architecture. First, yes, market incentives were not always conducive to safeguarding financial stability. To the contrary, we had moral hazard, we had conflict of interests, asymmetric information. All this contributed to the build-up of unsustainable positions at the individual level and at the system-wide imbalances. Second, yes, supervision and regulation of financial markets proved to be insufficient at some major segments, were completely left out, or pieces of information were not effectively put together. This relates very much to the off-balance sheets. Just a few years, I think in 2006 or 7, the off-balance sheet activities of the Citibank or Citigroup were larger than the on-balance sheet activities. There's a whole question of the non-banks. But thirdly, international institutions didn't succeed either in correctly identifying financial market vulnerabilities, or, if so, they did not make themselves heard and initiated countermeasures by relevant authorities. On financial regulation, to take the first part of the paper, I think you mentioned 6 areas which are, yes, at the core of this effort in expanding the scope of supervision and regulation. In Pittsburgh, we agreed to include all financial institutions, markets, and instruments. In aligning incentives, in increasing transparencies, and in strengthening buffers. And one should be clear, we have made considerable progress already, but of course, yes, much more needs to be done. Let's say many countries have implemented more long-term oriented compensation practices. We are on the way. The bill is pending in Europe in increasing the transparency of derivative markets by standardization and central clearing. And I think the recent agreement in the Basel Committee on Banking Supervision on new capital standards was a major step forward. And I would disagree. It was said that the capital, or the quality of capital, was weak, and I think the opposite effectively took place. But we have, without any question, to further advance our reform agenda. And I think the next G20 summit in Seoul at the end of November, we have, let's say, as a major issue to deal with the CFIs. Maybe concentrate on the issue of what we call globally, systemically financial important institutions. That means at first banks, but it also could mean at a later step, because more intellectual work has to do here, insurance companies, that means non-banks. At Seoul we have again the question of OTC derivatives. There will be an FSB report on how to reduce the reliance on the use of external ratings in supervisory affairs. So I think we still have a lot to do on the reform agenda, and Seoul will be a right step forward here. And then it's very much about implementation, which is done at the national level of for us in Europe, mainly at the community level of the European Union. And here it's a key question if and when, for example, the US will implement the rules and regulations of Basel III. When it comes to the institutions, the paper focuses on two, the IMF and the FSB. Yes, they have to play a major role in helping to safeguard the financial system, and they have mandates that are designed to complement each other. It's, I think, well described in the paper what is the responsibility of the fund and what is the responsibility of the FSB. I can agree here. I think a very good example of the working together and that has improved every 6 months is the early warning exercise that both institutions do together. We will have this evening again. On the governance, yes, legitimacy is a focal point for any international institution, and countries have to be adequately represented in the organization and the decision-making process, but that has to go hand in hand with a clear commitment. And the commitment, let's say, for the fund means also to participate in financing these institutions and its activities. I think starting with the FSB, a major step forward was 1.5 years ago as a clear result of the crisis to expand the membership of the FSB to all G20 countries. I think that was very, very important to make the FSB more inclusive and have a broader picture in the debate and the decision making on financial market issues. And I think it is positive, and the paper, I have the impression, sees the slightly negative, that at the FSB most members are represented by their central bank, their supervisory agency and their treasury. I think, and that is the most valuable tool of the FSB composition, that you have these three institutions or these 3 points of views combined in one meeting. And I think that is, compared to many other groupings and meeting, the most valuable effect of the FSB. You have a cross-country, cross-sector and cross-institutional approach, and this is a major strength of the FSB. I know Mario has elaborated in his speech about the outreach activities of the FSB with non-member countries. This is key to extend this in the future. We are dealing already with the issue of capital flows, but that will need high attention in the future. What I not agree upon is, let's say, what is on, especially in page 48 of the paper, that the FSB, or let's say that the fund can call on the FSB, that it can task the FSB. There is a kind of superiority in the organization which I think is not helpful when it comes to the tasks, and what is Ted said in square brackets, that at the end the FSB should be integrated into the IMF. I think the FSB has to play its own role in his, as I said, specific composition. It is more flexible than the fund. It can quicker adapt because it's not such a formal institution as the IMF is. Yes, there's always a kind of tension between efficiency on one side and legitimacy on the other side. But I think the FSB has now, with full G20 membership and its outreach activities, has a very good balance found here. I will come to the end on the IMF governance reform, which are ongoing for very good reasons. We have agreed at the Pittsburgh summit to deliver results until the end of this year. I think we are making progress here on this issue at the annual meeting, but we probably would need more time to finalize the results. Changes should reflect the changing role of member countries in the world economy. The voice and the representation of dynamic, emerging and developing countries should be increased. But that also would mean that they have to take over greater responsibilities in financing the IMF's works. And we, of course, fully subscribe to what we agreed in Pittsburgh, to a shift of quota, let's say, by 5 to 6%. And we are aware that new realities in the world economy have also to be considered when discussing the composition and the size of the funds board. We would say that 24 seats strikes the right balance between effectiveness and inclusiveness, and I don't see a compelling reason for reducing this number. But I agree that we have to talk about the composition, and here European Union member countries have made an offer to give up to 2 seats in the board, but this is relied on that we have an overall comprehensive package that includes the size of the quota increase, the quota shift, size and composition of the board, the election of top management position, the role of the IMFC in the future, and the kind of voting procedure in the fund. So I think we will strike for a comprehensive reform package. We are on a good way here. We are making progress, but we will need probably some more time. Again, thank you very much.
The privilege of being on this very distinguished panel. But before I talk about the paper, I have to congratulate you, Fred, for the announcement that you passed out everyone that Carmen Reinhart is joining the Institute for International Institute for International Economics. I think many of you know that she's one of the most influential and cited scholars in the world. And I've had the privilege of working with her for much of the past decade. I will just concretely point out that a very widely used ranking in academics now is the RAPEC rankings, which she ranks in the top 50 economists in the world in all fields, and those lag several years on citation, so it essentially includes none of our joint work in those rankings. So that's quite a great day, I think, for the Institute. Anyway, this is a very thoughtful and constructive paper. We were asked to take off from where the paper left rather than to go into the details, so I'm gonna go in that spirit to pick up on a few things. First, I have to say, I've spent most of my life in academics, but I did have an experience working at the Federal Reserve and also at the International Monetary Fund. And I must say, in international institutions, particularly, the concept of work together is a very difficult mandate. I recognize many of you from the Federal Reserve, the International Monetary Fund, other international institutions, and at least many of the department directors I know would agree with the following, that when you were told you had to jointly write a paper with another department, that meant it would be twice as much work and half as good a product. And I think it is very challenging because the institutions are not necessarily set up that way. And then it was very interesting because Ted ended his comments noting, almost as an afterthought, the end game is going to have to be that the two are merged. And I actually think that's probably true. Jörg Asmussen gave a very good explanation of the benefits and the flexibility of the FSB. I actually would say the IMF has been a very adaptive institution over the years. I mean, it doesn't always happen overnight, but that's really, I think, how it's been so successful. And to some extent, the fact that its mandate is not X and the world has changed, that's a problem that the IMF has faced again and again and again. And so, maybe there's some scope, as you had in that final slide, to try to achieve this. Now, it's interesting to be, writing the sort of hopeful paper about global governance in a period where it's very challenged, where the power of the nation states is very large and becoming more diffuse as the emerging markets become more powerful. And I think this is going to throw constant challenges, really, that trace back to the governance, the objectives of these institutions. And yet, I just, as Gary stated very well in his presentation, you need coordination in financial regulation, because otherwise money flows to the lowest common denominator. And of course, the problem is spread to everyone. The German Chancellor had the temerity when she was chair of the G8 to suggest that maybe there should be a bit more financial regulation just in advance of the crisis. And, I think my interpretation of her remarks was that she sort of explained that the US and Britain are getting all the benefits, but we're all bearing the costs. And, she got her head handed to her by the British and the Americans at the time, but I think those remarks look rather prescient now. And it does reflect this tension that, the benefits don't just go to the banks who are arbitraging. They also go to the local jurisdictions. It's a big part of the success of the City of London, the City of New York, the United States, Britain, the financial sector. And there's no doubt there have been, I think clearly there have been big contributions, but it isn't such a simple matter to try to regulate at a global level, because there's this tension between the problems are shared internationally, but the benefits often accrue not just to the banks, but to the individual countries. And I don't think this is at all just about political contributions, political influence, as some have argued. I think it's much broader than that. That it can be a very good business, and you want to cultivate it. I do think there's a deeper question that needs to be asked in this whole thing about what exactly are the benefits to international finance. Where are the big gains? There clearly are, but where are the big social gains? Where are the private gains coming? And I don't think, unfortunately, we academics have a very good answer to that question. There's certainly a sense that some of what goes on in international finance is somehow leveraging side payments from the taxpayer, moral hazard, these other issues. And I think it's a very tough question. Obviously, before the crisis, I won't name names, but we all heard speeches at meetings like this about how, well, it's all very complicated, but it's actually spreading out risk, and it's good for causing the great moderation, it's reducing volatility, it's improving growth. And I think you could take an exaggerated view in the other direction now, but I think it's fair to say we don't have a clear idea. And we have a lot of papers on financial intermediation and growth that really look at developing countries. How do they go from being poor emerging markets to middle income? We don't have as much as concrete a notion about the benefits of going from having sort of a very complex financial system to a very, very complex financial system. To paraphrase the head of Goldman Sachs, there were certainly a lot of economists who would have said, all these derivatives and complex financial dealings were doing God's work of completing financial markets, because that's what our Arrow de Breu model showed would be ideal. And it's clearly something that's complicated. And I lay that as a question. I don't think we want to go, back to the past completely. But that is really a big part of the question about some of the more complex arbitrage opportunities, the complex regulation around markets where it's not quite clear they should exist, that the benefits are really there. And let me just conclude by saying, referring to something in my joint work with Carmen, which, by the way, it's all academic, and academics are listed in alphabetical order, Reinhart and Rogoff, in all our work. But I think one of the things that sort of intrigued us and for us was exciting as the results unfolded was, particularly if you look at the aftermath, the financial crises, how similar they are on housing prices, on unemployment, on output. Why would you expect that? Different political systems, historical circumstances, legal systems. You could make a very long list. And yet, quantitatively, not just qualitatively, quantitatively, they seem, at least with the numbers we have, to be surprisingly similar. And I think, it sort of says something. There's something deeper going on in how our financial systems are enforced, crafted, where, at some level, the question of the financial architecture is all about governance and how we interpret it. Anyway, I should just finally say that I've found this kind of paper Ted's written in the past been very useful. I've used them in his books, sometimes in my courses, because it's not only a matter of the issues, but laying out very clearly what the heck these institutions do. There are not that many places you can actually find that explained and categorized. So the paper serves useful functions on a number of dimensions. Thank you.
Thank you, Ken. Guillermo.
First, let me thank the Institute. Thank you for inviting me. Is this on?
Push the buttons.
Okay. First, let me thank the Institute for inviting me to participate in this session. Like Ken, I found the paper, very interesting, informative, comprehensive, and let me take off. Let me. I'm sorry. Start where Ken finished and talk a little bit about the financial sector and then the institutional setting. I think that what the crisis demonstrated was that there was a massive institutional failure involving private financial institutions, involving regulators, involving, of course, rating agencies, and also international financial organizations like the IMF and the Financial Stability Board, that was called at the time. Now, the question is why? Well, the Financial Stability Board, prior to its current reincarnation, did not really have a lot of visibility, and the mandate was much narrower than it's today. So one has to ask the question, why did the IMF not only, I'm not saying that the IMF should have predicted the crisis, because that's impossible, but why did it not warn of the vulnerabilities that were developing in the financial sector? As Ken was saying, in his book, it's a great book, by the way, the striking thing is the similarity of all financial crises, and they are all, one common denominator among others, of course, is that they all start with big credit expansions, and the upshot is that ultimately people cannot pay them, and that manifests itself in different ways. And there were so many people that were at the time warning about the vulnerabilities and the connection between global imbalances and financial risks and so on, but yet the fund failed to put this in its mainstream view. And I guess the reason why that happened was that the fund adhered to the then existing paradigm that financial institutions and financial markets not only allocated resources well, but they also manage risk. Ken was referring to the complexity of financial products. I think the fund bought into this very much, the virtues of securitization and dispersion of risk and so on, and that did not, obviously that did not occur. Now, going into the institutional setting, one has to, if one starts from the premise that the fund failed both in its bilateral surveillance with the US and its multilateral surveillance role, apart from this intellectual capture, is there anything within the institution, is there anything in the, let's say, governance of the institution that could have yielded a better result? It's a difficult question to answer. But we have been talking about IMF reform for many, many years. 2 years ago, the managing director commissioned a group of people. I was included in that group. And under the chair of Trevor Manuel from South Africa, we produced a report with a set of recommendations for IMF governance reform. Then last year, the G30 produced another report on IMF reform. So I'm not going to go through all this. I also participated in that group. But our main recommendations, of course, were some that Mr. Rasmussen was mentioning, and that and the main one, of course, is quota reform, voice and representation, because that's the only way the IMF can have the legitimacy for its surveillance functions. We are today embarked on a huge discussion about currency, I would say, wars, and well, the IMF is just a little bit silent about. Let's see what happens over the weekend. But I'm not I'm not hopeful that a lot of it will happen. It's arithmetically very difficult to think that all countries can stop their currencies from appreciating. But anyway, I mean, one of the basic functions of the fund should be, precisely to gather the main players, in the context of G20 or IMC, and resolve this question. I mean, there's clearly something wrong with the international monetary system that produces a result such as the one we're seeing today. So, basic recommendations, of course, quota alignments. Even with the 2008 quota reform, Belgium will have a quota that's higher than Mexico or Brazil. Germany, UK and France will have a quota which is greater than China, and China is the second largest economy in the world, and much larger if you take PPP calculations. So I mean, it's pretty obvious that this has happened, but Mr. Rasmussen said that we're not going to be finished by this year. We may take some more time, but we're making progress. This weekend. Okay, I'm sorry. I hope that we finish by the G20 meeting in November. So I mean, the other parts of the recommendations on IMF reform were the activation of the council. That is a council. It's in the Articles of Agreement, and that would imply a lot more political commitment on the part of the membership. And finally, we recommended also that the managing director would be elected on a merit base and not by nationality. And that should apply also to the whole management structure of the fund. Now, turning to the Financial Stability Board, I think they have done actually a pretty good job in producing, in let's say, coordinating all these standard setters that are independent. They have different governance structures, and the mandate of the FSB is one of coordination. I think they have achieved that. They've done, I think, a quite good job. And obviously, one can be disappointed or not, like Ted was saying, with the outcome. But I think that, and I agree with Mr. Rasmussen, that this was a very important step forward. Now, on the relation between the IMF and the Financial Stability Board, well, this is an open question because obviously the responsibilities overlap. And I don't know, maybe in the long run they may be merged, as the authors of the paper were suggested. I sincerely doubt that. And I think that we have to keep a flexible mind in terms of sort of the geometry of international cooperation and international organizations. I think that it's inevitable that this overlapping, this function overlapping would lead to perhaps inefficiencies and maybe turf fights, and this can be costly because I mean, obviously we cannot afford that. So what we suggested in the G30 report was perhaps a practical way of looking at these issues is to write a memorandum of understanding between the IMF and the Financial Stability Board that would clarify each other's responsibilities and would set the basis for cooperation. For example, talking about the implementation of the standards, one can think of joint surveillance missions between the IMF, in the IMF and the FSB. I'm out of time, so I'll end up here. And again, thank you very much for the invitation.
Thank you, Guillermo. You exhibited good central banker discipline in responding to the admonition that your time was up. Okay, the floor is open. Lots of food for thought on the table. Open for questions, comments, alternative views, suggestions. Yes. Nick.
Maybe just to start off the discussion, one of the recommendations before the eventual merger between the two organizations is that the monitoring of standards implementation and control of standards implementation would be a function for the FSB. Now, yes, the FSB has started peer reviews, but the main exercise in reviewing standards implementation is the Financial Stability Assessment Program, or Financial Sector Assessment Program, FSAP, of the IMF. So are you advocating that the FSB should take over the FSAP leadership? And if that's the case, what does that mean in terms of resources and internal organization of the FSB? Because it's clear that the FSB currently has a very good team, very highly qualified, but it's also very tiny and certainly not at a scale that would allow it to do that sort of thing. So basically, can you be a bit more specific on what you think in terms of reviewing standards implementation, which I think is an absolutely crucial function if global standards are to be credible?
Well, I think actually our point was the reverse, Nicolas, just so we're clear. So the presumption is, as you say, that the FSAPs will be the major issue, but it also has been mandated by the G20 leaders that there be a certain degree of peer review and even beyond peer review within the implementation or the quality of standards, quality of supervision by the FSB itself, and that actually has created a degree of tension in this area, in particular by the non-G20 countries, as you might guess. But at one level, you could argue you can't have, since they're both types of peer review processes, some duplication of peer review processes probably is not all bad. They might actually compete with each other a little bit. But it's easy to see also how it could get messed up. So we were actually pointing to that as a problem where there is actually some potential for tension on those grounds.
Yeah.
Thank you. Is this working?
Yeah, please identify.
My name is Richard Erb. I was formerly with the IMF. I now live in Montana. And listening to Guillermo Ortiz at the end, he referred to a memo of understanding between the IMF and the FSB. I think in the time that I was at the IMF, we had at least 3 negotiations between the World Bank and the IMF, trying to come up with an agreement on how to work together and how to do things jointly. And I think they've continued to have those negotiations. So I guess I'm a bit of a skeptic, or I guess I see what the difficulties are. in trying to coordinate two bodies with very different responsibilities and mandates. Even merging it poses that same challenge within the organization, a management challenge. I guess I would add, and because among the recommendations is the need to, let's see here, add financial expertise to IMF resources, which I agree, and I think they've been doing that. But I think it's also a matter of looking at the decision-making bodies too, the executive board of the IMF and the IMF committee, because I think you also need to have in those two bodies the expertise and, as importantly, the links between the executive board members and their national capitals and the bodies and the organizations in their national capitals who have responsibility for regulation. The same thing would be true with the IMFC, that take the U.S. representation on that. Some of the most important regulatory bodies don't even come with the U.S. delegation to those meetings. Of course, that the Fed does, which is, of course, Ted, the most important regulatory body, I know that. But you have other regulatory bodies, and one of the issues here is coordination, for this country anyway, among some of the regulatory bodies. So I guess I would maybe ask Ted to comment, or Gary, because he's had the inside experience too.
Could I just add to the question to Guillermo, because he raised the idea about a memorandum of understanding. I think either Gary or Ted, or in their paper, did mention there was an agreement between the two. Just coincidentally, Mario Draghi was explaining to me over lunch how that happened to come about. But they do have an agreement, and so I guess that's to Guillermo. What would be new and different about your memorandum of understanding?
It's living by the agreement. That's the challenge.
Well, okay.
Gary.
Well, of course, Dick is right. Since I was an ED at the fund in the 80s, I had the good fortune of working also with it. But it's been an impossible task to coordinate the IMF and the World Bank in an efficient manner, and it's been tried many, many times. So why would this work? I think that in the case of the FSB and the IMF, the focus is much more narrow. These are issues on financial system. Already the standard setters have come up with a set of recommendations. So the question now is implementation and surveillance. So I think that, given the narrower focus of the overlapping responsibility, should be an easier task than to coordinate the World Bank and the IMF.
I couldn't agree more with Dick's point on having more financial expertise sitting around the governing bodies. It's not that it isn't there. It's that it's not really thought about when appointments are made, I think. And there are very knowledgeable, competent people sitting around that board table making important decisions, but they often don't have the expertise that's required to fully understand and deliberate on specific issues. So I think raising the level of financial expertise on the staff as well as the governing bodies would help. While I have the mic, if I could respond to some other comments that were made here. First, I'd like to clarify what I said about the quality of capital. I think Basel III is a big step forward in terms of defining core capital. But the definition of core capital that was agreed was a weakened definition from the one that was agreed at an earlier G20 summit by the leaders. So a consensus could not be reached on that stronger definition. So yes, the definition of core capital is much stronger now, given the agreement from pre-crisis. But there was a hope that would be even stronger, and that was watered down a bit. There's no question capital requirements have been raised significantly. So I just wanted to clarify that. I'm a little reluctant to get into this, but I'm going to go for it anyway. I'm just going to go back to Ken's agreement with our bracketed statement that a merger is inevitable. I was at the IMF working, co-managing the capital markets report exercise, which some of you know about at the time that the FSF was introduced. And over the years, I have asked many people the reasons why it was created, because the same work could have been done within the IMF. You could have had a secretariat established in the IMF. And the IMF had the resources, it had the modeling capability, it had the access to central banks and finance ministries. On the capital markets exercise, we used to speak frequently with regulators, supervisors, and especially the major institutions throughout the world. And we used to do it several times a year. So the reason given that I hear the most was that the international community, in the aftermath of the Asian crisis and the Russian default, and many other mistakes that may have been made in managing crises, inevitably you're going to make mistakes, that a clear message needed to be sent to the IMF by the leaders, or at least by finance ministers and central bank governors. And so that was the reason for setting up this FSF. Now, is it true or not? I don't know. But as an insider at the time, there seems to be a grain of truth in that it was to send a strong signal to the IMF because it made these mistakes.
Competition is a good thing.
Well, I agree, it is. I'm not going to defend the IMF from what you said, that the IMF missed this. The IMF probably missed other periods of imbalances. But that doesn't mean that there aren't those in the IMF who see them and even write papers about them and even bring those papers to the board. There are two problems. One is that even the work that was done within the IMF by some departments, through the WIO, through the GFSR, or what used to be the Capital Markets Report, a lot of that work just didn't get disseminated into the country work. And sometimes it takes many iterations to get that work flowing into the country work and the country assessments. So that was one weakness in the fund. I think that's being worked out now. Again, I'm not defending the fund. I retired from the fund, by the way, so I'm not even on sabbatical anymore. I'm separated. So that's one issue. There is work going on. It doesn't get incorporated into the area department work. That's changing. I think I'll stop there.
Okay, let me maybe in the 10 or so minutes we've got left bring another major issue back to the discussion. Jorg Asmussen, in his very interesting comments, mentioned this ongoing debate about the size of the executive board, some of the disagreements over representation, who has the chairs, what should be the resolution of that, if not this weekend, over the next few weeks, month leading up to the G20 summit in Seoul. I can't resist noting that my colleague, Dr. Truman, has held forth on that issue once or twice, and if I might ask him to share with us his latest thinking on what ought to be done and how to get it done.
I didn't really ask for this. I apologize. I mean, I have, maybe I should put it this way, maybe on several of these points. The role, I think, constructive role of think tanks, and Fred sets a high standard, is to be provocative and to force, or try to lead policymakers to be more, to strive for more in what they're trying to achieve, whether it's on capital standards, or IMF Governance Reform. I mean, I think I mean, broadly, State Secretary Asmussen embraced the agenda, and I think there is a case, but it's more of a technical case for a smaller executive board because it would actually save money, and the executive boards are very expensive at the fund. That's my central banking hat, or fiscal hat, if you want to put it that way. But, you know, I can see politically why it might not work that way. So I would think you actually could put in place a 20-person board, and it would be slightly more efficient, and it would be save money. That doesn't necessarily mean it's going to happen, and it's probably that dimension, the actual size of the board, is probably not I think the most important issue. I think the important issue, and I wish Jorg and his colleagues well, is to all the issues are now on the table. I think it's right to talk about them in terms of a package. There will have to be some discussion. There will obviously be some discussion about what's in the package. I personally agree with most of the ones he mentioned, or all of the ones he mentioned. Not necessarily the position, but that they're in. But they should be on the. But they should be as part of the package, and I wish them well. I think that's the basic point. So I'm declining to be, for the first time in my life, working with you, Fred, provocative, I guess.
Well, you had your chance.